Hi, welcome to the International Financial Management class. This subject is for BCom for 5th sem of Bangalore North University. This is the 22nd session. In this session, I am going to explain net present value method. Recap of the previous class. In the last PPT, we had learned about accounting rate of return. Learning objectives of the chapter to understand the concept by solving tutorial problems. Session outcomes. Students will have knowledge about concept by solving NPV tutorial problems. In this slide, NPV means the present value of 1 rupee received after a particular period of time at a particular rate of discount is calculated using the following formula. Present value equals 1 divided by 1 plus interest. N means number of years. This is the formula of NPV. Next, coming to first problem. Compute the net present value of the project which requires an initial investment of rupees 1,60,000 and which involves a net cash inflow of rupees 48,000 each year for 6 years. The cost of funds is 8%. There is no scrap value. Present value of annuity rupee 1 for 6 years at 8% per annum is rupees 4.623. The solution here, when we multiply cash inflow with the annuity value, present value of annuity, PV factor. So when we multiply PV factor with net annual cash inflow, so we will get 2,21,904, from which we deduct initial cash outlay or initial investment, that is 1,60,000. Finally we get 61,904, 904, that is net present value. Illustration 2. A firm has initial investment of rupees 1 lakh and cash inflows as shown below. First is year column, second cash inflows column, third column is for present value factor of 10%. The details are given below. Find out net present value. The solution for second problem is calculation of net present value. So first column is here for 4 years, details are given in the problem. Second column is cash inflows which are given in the problem. Present value factor at 10%, that is also given in the problem. So here additional column is present value of each inflow, each cash inflow. So when we multiply first year cash inflow with the first year PV factor, present value factor, that comes to 45,450. When we multiply second year cash flow with the present value factor, that comes to 33,040. When we multiply third year cash flow with third year present value factor, that comes to 22,530. And finally, when we multiply fourth year cash inflow with present value factor, that comes to 6,830. When we make total of present value of 4 year cash inflow, that comes to 1,07,850, from which we need to deduct initial investment. When we deduct initial investment, we get 7,850. This is the net present value. Next, coming to third problem. From the following information, calculate net present value of the two projects and suggest which of the two projects should be accepted assuming discount rate at 10%. Particulars: initial investment 40,000 for a project X, 60,000 for project Y. Estimated life 5 years is for project X, 5 years is for project Y. Scrap value is 2000 for X, 4,000 for Y. And here, so cash inflows are given below, 5 years are given below, and project X having 5 years cash inflow, project Y also having 5 years cash inflow. So for project X, solution is, so here 5 years cash inflow, 5 years cash inflow details are given in the problem, and 5 years present value factor also given in the problem. So when we multiply first year cash inflow with first year present value factor, that comes to 9090, that is the present value of cash inflow. When we compare second year cash inflow with the second year present value, we will get 16,520. And when we multiply third year cash inflow with third year present value factor, then we will get 15,020. When we multiply sixth year cash inflow with sixth year present value, that comes to 4,098. And multiply 4,000 with 0.621, we will get 2,484. When we make a total of this column, that comes to 47,212. This is the present value of cash inflow total, from which we going to deduct we are going to deduct original investment, that is 40,000. Then finally we get 7,212, that is net present value. Next, coming to project X, project Y. Coming to project Y, so here cash inflow, present value factor. So these three columns details are given in the problem. So what we did for project Y, project X. So here also we are doing the same thing. We multiply first year cash inflow with first year PV factor, that comes to 36,360. Likewise, we must do calculation like this. So then when we make total of last column, that comes to 66,972, that is the present value of cash inflow, from which when we are going to deduct original investment 60,000, then finally we get 6,972. This is net present value. So conclusion, which project is better? By using NPV method, we did a comparison between these two projects. Among these two, which one is the better one? Which project guaranteed more profits, more NPV? That is the best one. That is which what we going to choose. Select. So here, so X 7,212 NPV, Y 6,972. So project X is profitable because that project having more NPV. Next, coming to multiple choice questions. First question is, what is the present value of rupees 5,20,000 expected to be received in 3 years time if the business concern requires a return of 10% on sum invested? Out of 4 options, the right answer is D, rupees 3,90,000. So next, coming to second choice question, a project would normally be undertaken if its net present value is dash. Out of 4 options, the correct answer is D, positive. Coming to third question, an asset initially cost rupees 1 lakh. It is expected to last for 5 years and it will be worthless at the end of this time. Depreciation is charged on a straight line basis over the asset's useful life. Given the following profits from the investment, what is its net present value assuming a discount rate of 10%. Year for 5 years are given, profits 5 years profits are given. The right answer is out of four options, the right answer is A, that is 22,284. So it is the answer. You can do solution by using a formula, so then you finally get this answer. Next, fourth question is, a project has been tested for its feasibility, has already incurred market research cost of rupees 50,000. The actual cost of asset is rupees 1 lakh, and the project is expected to yield the following returns. So 3 years are given, 3 years profits are given. If the discount rate is 12%, the NPV of the project will be among which one among four options? The right answer is B, rupees 94,000. So this result you people going to get when you people using the formula. Next, last one. Which of the following statement is true? Out of four statement, the correct right answer is A. Investments that have positive net present value should be considered for acceptance. Reference. So the information for making PPT, we were getting information from International Financial Management. Dr. Goswami Khartoon is the author of that book, and management as well. Thank you.